Hello and welcome everyone to another market commentary from StashAway. It's the year 2022, so hope you all had a good start to the year. Obviously, the first 11 days, Freddy and Stephanie, it's been a rough ride so far, but I think we get into it here in a second because we also wanted to take a step back, right, and really look at the bigger picture items here that are coming up for 2022. So, with that being said, we talked a lot about inflation already towards the end of the last year. It's been picking up in the US. It's been picking up in Europe, right? We have gas prices reaching highs. So what's next for inflation, Stephanie?
Yeah, I guess, inflation has been in the forefront of, not just ourselves, but also recently the Fed as well. As we've all seen, the Fed has actually made a pretty big transition. Not talk about inflation to in December, where they said, inflation is something that's on the agenda. And that triggered quite a bit of market reaction, both in fixed income markets as well as in other risky markets. So what's next for inflation? We looked back in the last year. Basically, inflation has been a theme that we've been talking about for quite some time, and that triggered our June reoptimization of our portfolios, in which, if you remember, we added quite a bit of inflation protection to all our portfolios by changing some of the allocations to assets that would benefit from inflation. Towards the end of the year, we actually see inflation not subsiding, but actually accelerating. So if you look at U.S. in particular, the U.S. headline CPI, inflation reached about 7% in the latest reading. And even if you take out the more volatile components, which is energy and food, the core inflation is still quite high. And that's because goods inflation has been going up. Now, goods inflation is actually quite interesting because throughout the last few years, goods inflation has actually been non-existent or even negative. So we've seen some actually goods deflation due to technology, etc. But the reason why goods inflation is actually picking up is because, number one, the supply constraints that are posed by COVID that we've talked about. And then number two, if you look at some of the exporting countries, for example, U.S. imports a lot of goods from China, and renminbi has actually strengthened more than 12% against US dollar as well as other basket of currencies. So these are all factors adding to the pressure in the US inflation. We see that, these kind of inflationary pressures are here to stay with us, at least for the first half of this year. So inflation is something that we should definitely still pay attention to.
Absolutely. Funny story, because I was just in Germany and I remember everyone was rushing at the end of the year to IKEA to buy things because on the 1st of January, they started raising prices on everything by 5 to 10%. So it's becoming more real for people, right? It was not just IKEA, it was actually quite a few. I think Rolex also, had an increase in their base prices, right? So everyone kind of took the first of the year to kind of increase these prices. So it became really real because in the news more, right? And people feel it in their pocket. So with that being said, we hear a lot of chatter, obviously from the Federal Reserve to raise interest rates to combat some of that inflation, right? But when we look, at China, they already did some tightening, over the last, 12 to 13 months. So, Freddie, where do you see China in this picture, and where do you see them, and how do you feel about asset allocation at that point then, knowing those two?
Well, it's clear. Thanks, Stephanie, for the exposition on inflation. When we first did the reop in July, people were surprised that we were concerned about U.S. getting all the inflation from elsewhere because it has never happened before. And then it happened. But now the rest of the world is also starting to see inflation, right? So it's going everywhere. So that team is not going to go away. However, China has done its cleanup in terms of the regulatory reform, and it's done a lot of tightening in terms of money supply, credit activities, credit lending in the system is all-time low. And what happened now is there's a lot of signaling from the sort of authority side that this year is a year where they're going to refocus on growth. Whereas on the other hand, the U.S. is actually trying to tighten. Core inflation is 4.9%, is pretty high, never seen. That's why they're hiking. They're going to hike 3-4 times, this year, perhaps they're going to start slowing the balance sheet that they had accumulated roughly $8 trillion. They're going to stop accumulating, might even have to unwind some assets. And next year, they're going to do a few more hikes. That's a signal from the Federal Reserve. Whether it's a mistake or not, we don't know, but that is a signal. And on the other hand, China is signaling the other way. So from a portfolio standpoint, this is wonderful because as a global investors, this is exactly what you need to have diversification across the group. Because if every country is synchronized in policies, you don't get that diversification as much, right? So this is beautiful, I think, in our view as a global portfolio. And similarly, China's 40% emerging markets in terms of impact. I think that's Asia, Japan 40%, emerging market maybe around 25-ish. But what I'm saying is that then the China cycle would also start filtering and help emerging markets. Some of the emerging markets are the exporters of inflation to the US, right? So they are, from a global standpoint, a fantastic and super interesting year in terms of 2022. And there's a lot we can do to harness and to capture value.
No, absolutely. I think it's a great update, Freddy. Thank you for that and how we're positioned. What I do want to talk about, we talked about this a little bit before when we also did a podcast on our new thematic portfolios, right? There's a lot of talk about this, fourth industrial revolution that we're moving into. Are we on the cusp of it? Are we already started to see in it? Where are we in the fourth industrial revolution cycle? And also knowing that, or most of our listeners at least know that we have thematic portfolios that really take advantage of certain sectors in that fourth industrial revolution. How are they set up and how are we taking advantage of that?
Well, that's a really interesting question. First of all, the words on the cups of the fourth one, as you mentioned, but it's hard to prove, but it's just more observational and a lot of reading resources that says China is a clear leader in this one, but not because they are the inventors. They are more because they're adopting it on an industrial scale. And China is a huge country. They're adopting it throughout the nation in many, 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 many ways. So I leave it at that. There's a lot of sources on that. But I think that different technologies, will have different cycle as well. So the thematic portfolio actually focuses on, first of all, the first line of defense, diversifying within the team. So you may have particular technology such as robotics is sort of still early adoption. You might even have something that's even a bit ahead of that. That could be blockchain, right? Or electric vehicle. From a world perspective, they still fall into the very left side of the adoption curve, very early stage. And if they gain massive scale, it's phenomenal upside. On the other hand, you also have the more mature sectors that's already at scale and may start just tapering off. So things like social media platforms, right? Those are very old names. Even education tech is starting to become more on the right-hand side of the adoption curve. So what the thematic portfolio is trying to do is to find different parts of the adoption curve to build the thematic portfolio with. Some on the left side, some on the bit more into the middle side, some on a little bit on the right side to just balance the result, right? And so that's what we're trying to do. And the second thing that we did was we still respect the StashAway risk index. Everybody would have. We believe that thematic investments, they are more volatile in nature. There's more uncertainty to get to the bright future because they're early stage. The market don't appreciate them as much yet or don't know how to value them as much yet. However, we shouldn't be cut out from making the investment because of our lower risk tolerances. So we built a bunch of StashAway risk indices, mixing in protective assets with the thematic assets that gives every user a wider amount of risk point to choose from. So you're not cut out from making such investment because of risk level differences. So I'll stop here for Stephanie to say something too, because she's as much involved as I am in every of those moonshot projects.
Yeah, I'm just going to say we're living very exciting times where a lot of these technologies that will change our lives in the next decade are just at the beginning. And investors like ourselves are in a very good position to actually capture the growth over the next decade. I mean, Freddy referred to the fourth industrial revolution. And I mean, some of these technologies would be as important as electricity or invention of automobiles, etc. And I mean, we're witnessing that every day. So that's kind of the rationale behind thematic investment, and also kind of why we're creating all these different portfolios for our investors to get exposure.
Yeah, no, absolutely. So thank you both for giving that overview. It was really insightful. And if any of you listeners have any more questions, follow-up questions from today, or just questions about StashAway or our investments in general, please feel free to reach out to us at support@stashaway.com, or you can also write your questions in the comments under the video, and we'll definitely get to them over the next couple of weeks. With that being said, if you want to learn a little bit more, we have a few webinars coming up for our Singapore and Malaysia audience. We have one joint webinar. It's called How Venture Capitalists Choose Companies to Invest in. That's on Tuesday, the 25th of January, 2022, 7 p.m. So if you're interested in learning how VCs work, how they choose companies, and maybe that's something for you, join us for that webinar. The sign-up links are in the show notes below, as well as on our website. And then for our Malaysia audience, we have two additional webinars, one on the 19th of January. It's a Wednesday. It's called What is Your Financial Plan B? So not only, investing is part of your financial plan, but you also have to have a financial plan B if something goes sour. So if you want to learn about that, Wednesday, 19th of January, 6 p.m. local time. And we also have on the 26th of January, an inside look into StashAway. So if you wanted to learn something about StashAway, ask us any questions live during the webinar, feel free to join us for that Wednesday, 26th of January, 6 p.m. local time. With that being said, thank you both, Stephanie and Freddy, for joining us again today, and the audience for listening. And we'll be back with you in just a week or two. So until then, talk to you soon. Bye-bye.
Subscribe to our YouTube channel to get notified whenever we have new content out for you. Also, don't forget to download the StashAway app. It's available in the Apple App Store as well as the Google Play Store. So you can start on your financial journey right now.